Good evening and welcome back to Rainbow Investing, where we examine a spectrum of ideas to increase your long-term wealth. Now tonight we're going to do a video on how to build a dividend portfolio and talk about what kind of dividend paying shares might be right for you. Because I was actually thinking about dividend paying shares, and there's actually two types of dividend paying shares that I've identified, and I think it's important that if you're considering building a dividend portfolio that you consider, because one might be good for your goals and one might not be, depending on your profile and your investing horizon. So just before we get started, if you haven't already, make sure you hit that subscribe button. We do videos on personal finance and investing. And if you find this video, make sure you leave a like on it. It really helps my channel out. But without further ado, let's get going. So for those of you who don't know, a dividend is a payment by a company for owning the shares. It's as simple as that. Now in Australia, we have a very unique tax system that actually favors dividend paying companies. So you'll actually find that most major companies in Australia or listed on the Australian Stock Exchange will pay a dividend. Because actually if you live in the US or the UK or most other developed countries that I know of, dividends actually get taxed twice. So what happens is a company will make a profit. The profit of the company is taxed with the company tax rate. And then after the profit is paid, that's when the companies distribute the dividends. They have to do it post-profit. And then when you get that dividend check in the mail, you have to count that dividend as part of your income, so it gets taxed again. So dividends are taxed twice in most other countries, but not Australia. We have a system called dividend franking, which means that when you get the dividend in the mail, you will get a refund from the tax office for the tax that the company has paid on the profit already. So your dividends will only get taxed once. So that's why in Australia, dividends are very, very popular with investors because we get favorable tax treatment compared to, say, the US. In the US, your dividend will get taxed twice before it comes to you. So that leads to some Australian companies paying very, very high dividends because they know that their investors like it. So I've identified two kinds of dividend paying stocks or shares that you should think about if you're building a dividend portfolio. Now I've called them dividend growth shares and dividend income shares, and I'll explain the difference in just a sec. So most companies will either identify it as one or the other if you actually analyze their dividend payouts and their payout ratios. So a dividend income stock is a company that pays a very high dividend off the bat. So if you hear maybe some older investors talking about dividend payers, they're normally talking about companies like the Commonwealth Bank, the other big four banks, maybe Telstra, maybe BHP Billiton, maybe Woolworths, maybe Wesfarmers. Companies like that, really well-known companies, often pay large dividend yields straight off the bat. So when I say large dividend yield, a dividend yield is actually a percentage number which represents the payout you will get from the dividends every year. So for example, a common dividend yield is 4%. That means that every $100 you have in, say, Woolworths shares, you will get $4 back every year, or 4% of your investment, based on the current prices. So that's what's meant by dividend yield. So dividend income shares often have high yields, and that's why I'm calling them income shares, because people normally buy them for their income, and usually only for that reason. So this often applies to retirees or people who aren't working and they're living off the dividends. Because if you're retired and your main investing objective is income, then you will favor these kind of shares because they pay the most proportional to your investment. So the main difference between these two types of dividend paying shares is how much of their profits they are paying out as dividends. Because with a dividend growth stock, you'll normally find that the companies are still growing. So they're actually reinvesting more money back into their own businesses rather than paying it out as dividends. So I've actually got two companies here which we're going to compare. One is NAB, or National Australia Bank, one of the big four banks on the Australian Stock Exchange, and the other is REA Group. Now you might not have heard of REA Group, but you probably will have heard of realestate.com, which is their flagship website that they run. So REA Group is what we call a dividend growth stock, and NAB is what we call a dividend income stock. So you can really see what I mean if you look at these two numbers here. So this is what's called the company's payout ratio. And that just means the percentage of their profit that they are paying out as dividends. So as you can see, NAB's payout ratio is 85%, which means that it's only keeping 15% of its profits internally investing in its own business. So that immediately tells you that NAB finds a better value in distributing 85% of its profits to its shareholders than it will get if it reinvests it back into its own business. On the other hand, REA Group's payout ratio is only 51%, which means that they are reinvesting about half their profit back into their business. And if you look at the bottom numbers here, it will tell you why. These numbers represent the return on invested capital. So that's the rate of return that these businesses expect if they reinvest their own money. So NAB is sitting on a return on invested capital percentage of 2.73, which means that if NAB reinvests money back into its business, it can expect to get a return of 2.73%, which is very, very low. That's about the rate of a government bond. REA Group, on the other hand, is getting a return on invested capital of 21%, which is really, really high. Most really good investors can't even hit that number. So you can tell that REA is a growth company because they can get this amazing rate of return if they reinvest their money. So REA Group thinks that rather than paying out a higher percentage of their profit, the money is better spent investing in its business, which will grow their share price more over the long run. Whereas with NAB, you can see that they're only getting a very poor rate of return when they reinvest their business. Because their business is so large, it actually can't grow that much more. And that's what this number represents. And that's why they have such a high payout ratio. They believe, and probably accurately, that their investors will respond better to a high dividend payout rate rather than getting this really low rate of return on their invested capital. So if you're a younger investor and you have a long time before you retire, or a long investing timeline in general, then you're going to want to go for these dividend growth companies because they're investing more money into their business, and by doing that, they'll be able to increase their dividend over time. Whereas NAB is already paying a solid dividend, so it's good for income, but the share price is probably not going to grow that much because they're not investing that much money back into their business because they're already so big. So when you're looking at dividend shares, it's really important to look at the dividend yield, the company's payout ratio, and the return on invested capital. And those three numbers will give you a pretty good idea about which category the stock might fall into. And maybe if it's falling more into a dividend income stock, then maybe it might not be the best stock for you unless you're explicitly looking for income. If you've got a bigger time horizon, it's better to go for these dividend growth stocks. Alright guys, I hope you found this video useful. If you did, make sure you leave a like on it, and if you haven't already, of course, make sure you hit that subscribe button. Thanks so much for watching. I'll be back with some more videos soon. But for now, good night.